Hi there, welcome to The Close. I'm Lindsay Biscaya. Markets are closing in half an hour from now. So first, let's get to some of the stories we're following in the BNN Bloomberg newsroom. The Canada Pension Plan Investment Board ended its fiscal year with a net return of 7.8%. The increase in assets was boosted by income and transfers from Canada Pension Plan. The returns were helped by holdings in public equities and real assets. The results fell short, though, of CPP's benchmark portfolio, which was boosted by heavier exposure to large tech companies. And we'll find out more when Amanda Lang speaks with John Graham, President and CEO of CPP Investments. You can watch that interview on Taking Stock. That's Friday at 3 p.m. Eastern. Shares of Lightspeed Commerce are taking a hit today. That's after the point of sale and software provider posted profit for its latest quarter that missed estimates. In addition, Lightspeed's revenue outlook for its current quarter, along with its fiscal 2027 goals, also missed the mark. And shares of IGM Financial are trading lower today. Mackenzie Investments, a unit of IGM, has cut a number of portfolio managers as part of a broader restructuring. Bloomberg is reporting the fund manager cut staff in its investment management, technology, and product divisions. The report follows a move by Mackenzie earlier this month where it made a series of changes to its manager and product lineup. And we are watching the TSX today. It's been seeing gains pretty much all day today, up by 0.8% at the moment, well above 34,000 points. Similar story now for U.S. markets, mostly in the green as we head to the closing bell. The S&P 500 up, same with the Dow Jones and the NASDAQ. This is, of course, because investors are waiting to see if maybe there's going to be some kind of peace deal coming out of the Middle East. So for more on some big movers today and his stock picks, joining us now is Danitai Fair, Senior Portfolio Manager at Caldwell Investment Management. It's great to have you join us. Thanks so much. So,
thanks for having me.
We've seen oil prices helping the TSX today. It's boosted up quite a bit, but weighing on U.S. stocks. Where do you see higher oil prices affecting Canadian earnings maybe in the long run?
Well, we think the Canadian market is probably set up pretty well from an earnings standpoint when it comes to the commodity side of things. So we think the price of oil will be elevated for some time, even if we get a resolution in the near term. And we just think the overall commodity cycle as well on the base metals looks pretty good as well. So the Canadian market should fare fairly well in this environment. But it could impact other sectors in a negative way. But overall, I think the Canadian market should fare well with these tailwinds.
Okay, so we're seeing that. On the flip side, though, one of the big movers on the index is software company Lightspeed Commerce. That company, though, plunging after its fourth quarter earnings missed. Do you see any catalyst or for a kind of long-term rebound for this company?
So the markets are very thematic right now. On the Canadian side, like I said, the commodity side of things looks pretty good. In the U.S., it's really been the theme around that AI story. So you have your sectors that are considered winners of that, and you have other sectors that are at risk of being, or the market believes they're at risk of being displaced or disrupted. So Lightspeed would kind of land into that bucket of risk of being disrupted. They're in that payment, point of sale payment type of market. It's a very, very competitive market to start off with, so it's a tough market. But on top of that, the sentiment in that sector is fairly weak. So the catalysts have that change. I'm just not sure when that will happen. We see it in other sectors as well. The overall software sectors have been very weak in the U.S. and in Canada. We've seen the same thing on the engineering side, on the consulting side. So there's a lot of different sectors that are under pressure. And, we just think that AI story has to play out a little more to see what kind of real damage, if there's any damage to some of these business models. Mm-hmm. And that could take, a few more quarters, maybe a couple of years before we really get to the bottom of what the overall impacts will be. Until then, it's really hard to fight the sentiment, and it's going to be really tough for these companies to be able to kind of get out of this funk until the market kind of gives them a green light.
No kidding. Another company that might need to get out of that funk when we're talking about U.S. stocks is Walmart. So it reported today a beat in the first quarter, but it's sliding. It's down almost 7% at the moment to end the day. Did you notice any red flags in the latest earnings report from Walmart?
Yeah, not really. It was a good quarter. if you look at most of the retailers that have come out with earnings the last few days, I'm thinking of TJ Maxx, Williams-Sonoma today. I believe it was Target yesterday. They all came out with some pretty strong, pretty good overall numbers. So the consumer still seems to be very resilient. If anything, Walmart may have seen a bit of trade down because the higher end consumer cohort, the volumes or the traffic has picked up there. So that's a positive for them. The one negative was they did see an impact from the cost of fuel. TJ Maxx pointed to that as well. Actually, TJ Maxx had a very strong quarter, but their outlook was somewhat altered a bit or softer than expected because of the impact that they expect from the cost of fuel for the rest of the year. So Walmart's seeing the same thing. They're not passing that through to the consumer, so they're taking that hit, but they have seen a pickup in traffic by doing that. So they are taking some market share. So overall, we think from what we've seen so far, the consumer still seems to be in pretty good spirits when it comes to shopping, but there are some basically some costs here that are going to probably start hitting some of the bottom line from an earnings standpoint.
When it comes to other stocks you like, Aritzia is one of those stocks. It's more than doubled in the past year. How much more room do you see for Aritzia in terms of growth?
So we think Aritzia is still in the very early days of that growth trajectory. They've been in Canada for a while now, so they're a little more mature here. But in the U.S., they still have a fairly small footprint if you compare it to this footprint they have in Canada. So their investments, their new stores, the payback period is like under a year. So the return on those investments are very high. They're growing at significant rates. Their same store sales for existing store sales, I think the most recent quarter was well over 20%, close to 28% year over year. So they have a very strong growth rate from a same store sale. They're still getting their name, the brand out there, and they still have a lot of room for new store openings as well in the U.S. And we haven't even talked of the international potential that they have somewhere down the road. So it's still very early days, and that's why we really like it. Apparel is a tough competitive business, but when you have a strong brand that's in the early days of that expansion, those types of investments can do very well.
Just in our last 30 seconds here, you don't have a lot of time, I apologize. Aecon Group is your other pick. What is it that you like about them? You feel like they still have room to grow as well?
They've changed their business model somewhat. They've reduced their exposure to these fixed type contracts, fixed cost contracts, which really reduces the risk in the overall business. Over 70% of their backlog right now is in those much lower risk type infrastructure projects, and there's just a lot of infrastructure projects coming down the pipeline. From AI data centers to transportation, to think of all the projects we have lined up in Canada, and more importantly, the nuclear division. Their nuclear division is close to 30% of the revenues today. Nuclear construction has very high barriers to entry. They're one of the companies has a very strong franchise there, and so we do see some really strong growth rate for them over the next few years. Okay,
Denis Taillefer, Senior Portfolio Manager at Caldwell Investment Management. Appreciate your time. Thank you.
Thanks for having me.
SpaceX is looking to go public on the NASDAQ, but we'll be diving into governance policies to know before you invest. That's coming up after the break. Stay with us. Elon Musk's SpaceX is preparing to go public in what could be a record-breaking IPO. The company is expected to list on the NASDAQ under the ticker SPCX. SpaceX has become NASA's primary launch partner since the space shuttle program ended in 2011 and now sits at the center of a massive, rapidly expanding space economy. So let's bring in Jeff Park, CEO and Director of Stack Capital for more. It's great to have you. Thanks so much for joining us.
Thanks so much for having us. Great time to be a SpaceX shareholder.
No kidding. So you've got 30% of your portfolio tied to SpaceX, and you've said recent growth has been driven largely by SpaceX and OpenAI. What's giving you the most confidence about SpaceX right now?
When you have a business that has one of the biggest TAMs in the world, you're touching almost every human on the planet. There's more than 2.8 billion people that don't have access to the internet. That's a really, really big opportunity that you can go after. The guy controls the launch market. So I have launch, I have Starlink satellites, and I'm sure some of your viewers probably have cabins or cottages where you don't have connectivity. this guy is giving connectivity to the world. So being able to invest in that and be a part of that, we were early, we were around $85 billion valuation in our portfolio. So we're quite excited to see this company go public. On top of that too, like we have a position in OpenAI as well. So like both those two companies, like we couldn't be more thrilled to be invested in right now for our shareholders.
I do want to talk about OpenAI in a minute, but I want to stay with SpaceX right now because the company is pointing to a massive addressable market as big as $28 trillion. What does that number actually represent?
A big portion of that, so they merged XAI into SpaceX. So it used to be solely SpaceX. Elon had XAI, he built that, acquired Twitter, and ended up merging that into SpaceX. A big portion of that is bringing agentic AI agents to the real world. And you can see like the growth from OpenAI, the growth from Anthropic. You can see how fast those companies are growing. So a big portion of that TAM is that. But also additionally too, with Starlink and 2.8 billion people not having access into any internet, that's a large portion of their TAM as well. So he does have a very big market that he's going after with both of those two pieces.
What are some of the scrutinies coming along with this announcement right now, the IPO?
I would say some of the scrutinies is you get, okay, Elon controls the underlying company. Yeah, super voting, it's a controlled company by Elon, which I think you should have control of that company. You have basically one of the largest telecommunication companies in the world, and I have faith, I have trust in him, where he's going to take that in the right direction. So there's scrutiny there. There's also a lot of chatter around the lockups and how is that going to work. And with the S1 filing that they came out with yesterday, you can see it's a staggered lockup because the market's never seen an IPO that's this big. You're talking about raising $75 billion at a $1.75 trillion valuation. The only thing that's come close to this was Saudi Aramco, which wasn't even listed on a U.S. exchange. It was listed over in the Middle East. So there's some chatter about how are those shares going to unlock? What's that going to look like? How does the index buying look like? So that's a lot of chatter out there in the market right now.
Is that a red flag to you, just how big this IPO is?
I know everyone says it's a very, very large IPO and raising $75 billion, but the amount of demand out there for this company, $75 billion actually isn't that much when you think about all of the index buying, passive buying, active buying that need to go into this. There's a lot of people out there who they hug the benchmark, they're index buyers, right? I don't think that they're going to have no position in SpaceX. They might be underweight, they might be neutral weight, they might be overweight. But I think there's a lot of people who don't own that company that are going to have to own that company because it's going to be such a big portion of the market.
There's also scrutiny around governance policies that appear to strip away like traditional shareholder protections, including the fact that Elon Musk effectively cannot be removed. Does that raise any red flags for you as an investor?
You got when you think about this business and what he's been able to build, like we're talking about our modern day Einstein. When you've been able to build companies like Neuralink, SpaceX, Tesla, Boring Company, like having him in control of that, I have complete faith in it. And then I think another piece that people scrutinize too is the pay package for him, which I'm a big fan of individuals making a significant amount of money if they're making a lot of money for other underlying shareholders. So I'm a big fan of both those underlying components for SpaceX.
I do want to bring in OpenAI quickly. You have exposure to them as well, as you mentioned. It's been caught up in a very public dispute with Elon Musk, though, obviously, as of late. How do you interpret that situation, and did it change your view of OpenAI at all?
I wouldn't say it's changed our view of OpenAI. I would say I like that we're kind of getting this behind you. I hear a few points from Elon. Elon essentially created that company. That's another one of the companies in this world that he's created, and can he not feel so great when he feels people took that away from him and something that he wanted to be in not in basically a for-profit corporation? I can understand that. Now, do I think Sam and Brockman have built a good business off that and are capitalizing on that for shareholders, and some of those shareholders can be pensions, endowments? I am happy with that as well. So I'm just glad that the legal battle is kind of getting over that, and I'm sure there's going to be appeal over time, but it's nice to see that the ruling went in favor of OpenAI because we own both. So we're happy that that's kind of getting over it. Okay, we'll leave it there. Jeff Park, CEO and Director of Stack Capital. Appreciate you joining us. Thank you. Thank you so much for the time. Coming up, Walmart reported stronger than expected results. We'll break all of that down right after this.
Walmart reported Q1 earnings this morning, warning rising fuel costs are squeezing the company's bottom line and could lead to higher prices for shoppers. To get into the details, we were joined by Jihan Ma, senior analyst at U.S. Broadlines and Hardlines Retail at Bernstein.
I would say on the one hand, Walmart is always known for guiding conservatively, so this is not a surprise. I think it's widely expected that they're going to maintain guidance for the rest of the year, and it's a guidance that consensus generally views as highly conservative. Now, to your earlier point, the rising fuel cost is adding some added pressure on top of an otherwise fairly supportive consumer environment that we foresaw in the beginning of the year, and now that's changing somewhat with the higher fuel cost. Walmart did mention that from Q2 onwards, they're going to start to find efficiencies, and maybe retail pricing is going to start to increase as they try to pass on some of the added fuel cost pressure. So I don't think this is going to be a permanent headwind necessarily for the full year. But I think on the one hand, it's causing some concerns about, how much more can they beat their current guidance from here? And is there downside from consensus expectations? And second of all, of course, people are generally fairly cautious about the consumer environment right now. So the market has been fairly punitive of any less than perfect prints so far this earnings season.
It's been a good earnings season. With the gas, from Walmart's internal side, do they have enough power to even drive gas prices down when they go to fill up for their trucks and everything out? The fuel expenses on their side. Do they have any leverage on that, or is it they're like everybody else just along for the ride?
I'm sure there's scale advantage. I guess the difference is Walmart does own their private fleet for the inbound freight, which is from the distribution centers to stores. So I guess there's less of a bargaining power with the 3PLs from a negotiation perspective. It's more in the sense of, they're already generating a lot of cost savings from their private fleet. They sometimes buy forward by a couple of weeks to hedge the diesel cost, but it's not perfectly hedged. And so in that sense, are they exposed to rising fuel prices as everybody else? Yes, in that sense.
Okay. And then, of course, on the other side, the customer, if their money is going towards gas, they don't have money to buy things. Is there anything Walmart can do to keep people coming in?
I think they're doing a great job, frankly. Their share gains have been accelerating. This is usually the environment where Walmart shines on the top line from a market share perspective. Just look at the value proposition they're able to offer. Look at the faster and faster delivery speed they're able to offer. In this environment, I would say, if you look across the income cohorts, no doubt the low-income consumers have come under pressure the most, the earliest. They have not really benefited from tax refund as much. Some benefits have been tweaked or taken away, and meanwhile, gas prices usually impact their spending power the most. That's where Walmart's pricing power really stands out. And meanwhile, the middle to high income consumers, even though they have been more shielded by tax refund so far, that's a one-time finite benefit. So as they work through the tax refund benefit, if energy inflation stays higher for longer, I think that's likely going to drive more middle to high income consumers under pressure as well, and driving trade down to Walmart, where they stand out to be a beneficiary as well.
So they could actually, you think they could actually win with the higher prices in some ways?
In the
higher
grand
fuel
scheme
prices.
of things, yes. In the near term, I would say they usually say, we're the last one to raise price. We want to provide really compelling value proposition in times when our consumers are stretched. So in the near term, what we saw in Q1 is they didn't take pricing to adjust for the energy inflation. And as a result, there has been some margin hit to Walmart. So near term, could be some noise from a timing-wise. Their pricing actions will lag the actual inflation when there's a sharply rising inflationary environment. But in the grand scheme of things, usually they should be able to pass on the cost inflation, and they're still cheaper than everyone else, which means that they're gaining share.
Okay, and then let's talk about Costco. It's coming out the end of May. What are we expecting there?
Costco should be, I would say, one of or the biggest beneficiary from gas inflation from a top-line perspective, because not only are they cheap, their gas station, their actual gas is cheaper than most of the other gas stations you can find in the US, which means they're seeing a lot more traffic going into the Costco gas stations. And when gas prices are high, you probably don't want to drive to another store that's 5 miles away. You might as well just shop at Costco. And Costco will say in this environment, they'll convert sub 50%.
That was Jihan Ma, senior analyst at U.S. Broadlines and Headlines Retail at Bernstein. Canadian fund manager Mackenzie Investments has laid off a number of portfolio managers as part of a broader restructuring. For more on this report, Bloomberg's Toronto's bureau chief Melissa Shin joins us now. Melissa, it's great to have you join us. So what exactly happened here at Mackenzie?
Yes, so as you mentioned, Mackenzie made some changes and sort of had a broader restructuring, it seems, as well as some of its portfolio managers being laid off. Staff were cut in investment management, product and technology. And earlier this month, the firm made some changes to its manager and product lineup. This includes global, small, and mid-cap equity fund, a U.S. mid-cap equity, and some fixed income strategies. And it does seem that these changes were related to some managers departing. One example being Phil Toller, who was a manager of some of these funds. He is no longer the manager, and according to his LinkedIn profile, he has left the firm.
It seems as though asset management firms are under pressure right now, right? Like, why is that?
Yes, so what we've seen over the past several years is what we call margin compression, very jargony, but essentially it means that costs are rising and the amount that investors are willing to pay to own mutual funds is decreasing. There's a lot of competition from lower cost investment vehicles like ETFs. And also on the other side, there's compliance costs, just the cost of doing business, inflation, et cetera, is increasing. And so this makes it very difficult to compete. And then on the other side, we have the rise of artificial intelligence, and investment managers are looking at how that's going to make their operations more efficient, which often means, unfortunately, that staff are being cut. And so you have a situation where there may be a lower cost way to do business, and sometimes that affects the people.
For sure. And obviously, it's always interesting to compare like how Canadian companies are doing versus companies around the world or U.S. companies. If you look at like JP Morgan, Goldman Sachs, how does this situation with Mackenzie compare to what's happening in the rest of the world?
Yes, so just more broadly on the artificial intelligence side, this morning in China, Jamie Dimon of JP Morgan said that they're looking at hiring more people who are AI specialists as opposed to bankers. And so, that means sort of a shift in the type of workforce and the type of people who are being hired. Goldman Sachs said that, the back office is really ripe for automation. You've got Standard Chartered in the US, or the UK rather, saying that, the lower value human capital can be replaced with technology. HSBC has made similar comments. So, this all, of course, remains to be seen. You sometimes see a swing where a lot of people are eliminated from their jobs, and then companies realize they sort of need to hire people back, and there's always sort of this cyclicality. But AI has sort of created a different dynamic, so we'll have to see.
For sure. Okay, Bloomberg's Melissa Shin, appreciate your time. Thank you. Up next, we've got the closing bells on Bay Street and Wall Street. Stay with us. Here are the closing bells at the NASDAQ. Amcor Technology is ringing the closing bell. On the New York Stock Exchange, BNY rings the closing bell. And on the TSX, Fidelity Investments Canada is closing the markets. You are watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on Bay and Wall Street today. TSX finished the day at 0.7%, led in a big way by the materials sector today, continuing to see gains there over the last couple of days, now at 34,400 points. The S&P 500 also up ever so slightly, and same with the NASDAQ. Most of these stocks actually, or markets, were down for majority of the day, so we saw a bit of a rebound to end the day. And now if we look at some of the big market movers, particularly those leading the TSX, BlackBerry was one of them. It's launching cyber pathways with UKM to strengthen cybersecurity in Malaysia. BlackBerry up almost 8% to end the day. MDA Space is another company that we are watching closely. It was up almost 3%. RBC is noting on its commercial defense prospects. So obviously giving MDA Space a bit of a boost there. Enbridge also up by more than a full percentage point to end the day. If we look at some of the laggers on the TSX, Lightspeed Commerce, we were talking about this company a little bit earlier. It was down more than 6% after its fourth quarter profit and guidance missed estimates. You can see investors feeling a little wary about this one. IGM Financial also down to end the day. We were talking about this too, down almost 3%. This comes after the fund firm McKinsey, which is a unit of IGM, as we were just talking to Melissa about, cuts portfolio managers, and you can see reflecting IGM to end the day. And for more, we are now joined by Bloomberg's equities reporter, Stephanie Hughes. Stephanie, it's good to see you. So let's talk a little more about Lightspeed Commerce. What are you watching for now that markets have closed and we've seen where Lightspeed has kind of finished the day?
Yeah, that's right, Lindsay. So it was kind of an interesting share price reaction just on the outset for Lightspeed because analysts were actually kind of expecting something more neutral in reaction to the results. But what happened was Lightspeed, those shares of the e-commerce firm fell by nearly 13% at its lowest point today, which marked its biggest intraday decline since February. And it was enough of a drop to bring the stock price down to its lowest level since April. That's because its adjusted earnings of 8 cents per share were a bit of a miss compared to what analysts were hoping to see. And the analyst team at JP Morgan did acknowledge that the fiscal 2027 guidance was also probably a little bit light, but also added that it still came ahead of their own estimates, just maybe didn't quite clear the hurdle for the broader analyst community. And looking at some of the analyst reactions, starting with that JP Morgan analyst that I mentioned, they acknowledged that the results were generally ahead of their expectations, but the street didn't likely account for the divestiture from Upserve, which is a software company for that specifically caters to the restaurant community. So there might be some skewing in their expectations there. And the analyst, like I mentioned at the top, they're kind of expecting a more of a neutral reaction, but what we had was a double-digit decline right out of the gate. That did, admittedly, to be fair, recoup some of those losses and end the day a little bit more modestly in the red. But Lightspeed, unfortunately for the firm, did spend the entire day being the worst performer on the TSX. The team at Stifel also acknowledged that it was a bit of a messy quarter with a lot going on with the guidance, the adjusted earnings miss, and then, of course, the Upserve divestment. But the underlying key performance indicators were still pretty solid, so they did feel good about that. So it's a bit of a messy quarter, but I think analysts and investors alike will have to take more time to digest what this actually means for the company, Lindsay.
For sure. Okay, we'll leave it there. Bloomberg's Stephanie Hughes joining us. Stephanie, thanks as always.
Thank you.
And joining us now for some movers south of the border is Bloomberg's Avalon Parnell. Avalon, great to see you. So we're going to talk about Intuit once again. It's one of the worst performers on the S&P 500 today. What's behind the sharp sell-off that we saw?
You're absolutely right. Intuit did fall about 20% into the close to end its worst one-day drop since 2003. That is partially after its earnings results fell short of expectations. More specifically, investors were particularly disappointed by the performance of TurboTax, which is one of its segments that, especially coming after our tax season, they were expecting to do quite well. Intuit also gave a growth outlook that Barclays said fell short of expectations and is likely not enough to mitigate investor concerns. It may even start to add some fuel to that AI bear case about how exactly will tax software companies be able to do when you have Anthropic and OpenAI potentially offering other options that will allow people to choose to go elsewhere.
For sure. We're also watching Walmart today. It's had a bit of a rough day. It's viewed as a bellwether for U.S. consumer health. What did investors take away from the results today?
Absolutely. Walmart did fall about 7% into the close. Not a great performance, even though they had a fairly good earnings results. That guidance for the second quarter is what was mainly in view for a lot of investors. More specifically, they warned about rising fuel costs really causing shoppers to really be mindful about where they are making those purchasing decisions. And with that, that is leading a lot of investors to have a lot of question marks about how exactly the U.S. consumer is doing in terms of that health.
Yeah, and of course, like Walmart looking at the low-income consumers versus the high-end consumers, seeing quite a difference there. On the flip side, Ralph Lauren was one of the best performers today. And obviously, Ralph Lauren, a bit more of a luxury brand. So what's behind the stock's strength today?
You're absolutely right. Ralph Lauren had 14% up for its best one-day leap since 2024, and that's partially because luxury shoppers are still going into their stores. More importantly for this company, Chinese customers were still choosing to go in, especially for the Chinese New Year. They were picking up a lot of goods, and Asia was one of the strongest areas for Ralph Lauren today. Also worth noting that BNP Paribas is saying that the guidance for the first quarter upcoming is also really good and should be applause-worthy. So investors were really excited that not only did they have a really good earnings results for this quarter, but it seems like the good times are going to stay continuing.
Okay, we will leave things there for now. That is Bloomberg's Avalon Purnell joining us. Avalon, appreciate it. Thank you. Up next, U.S. stocks recover as oil prices retreat. We've got more on the markets and some stock picks after the break. U.S. stocks recovered after a shaky start as oil prices fell back, but retail giant Walmart tumbled despite beating first quarter revenue estimates as it flagged the impact of higher fuel prices on customers. So let's go to Jack Ablin, Chief Investment Officer and founding partner at Crescent Capital. Great to have you join us. Thanks so much.
Thank you.
We'll start with Walmart plunging today despite the beating revenue estimates and coming in with earnings expectations. Where do you think the red flags really are here for Walmart?
Yeah, it's probably the stresses that their core customer base is feeling right now. That the SNAP benefits, which is like our food stamp program, isn't going far enough to satisfy a lot of households here. Yes, the high-end consumer is trading down and driving a lot of the Walmart share growth, according to their earnings call. But interestingly, we found that their gas stations, where they tend to have a lot of gas stations near on their premises, they said their average fill-up is less than 10 gallons, suggesting that their consumers are not taking a full tank of gas. They're just trying to limit what they can spend. So clearly, their core constituency is under stress. And that's part of the reason why I think we're seeing their shares down today.
Wow. Yeah, we've obviously seen oil prices rising. Today, they're falling for a third straight day. But over the course of a couple of months, obviously, you can't deny the price of gas has gone up, just the demand as well. So what do you think is the market's threshold in terms of just how far oil can climb?
Yeah, I think it's in many respects less about oil and more about interest rates. We've got now our 30-year Treasury has moved above 5%. Our 10-year Treasury is over 4.6. At some point, it's going to matter. When you look at, for example, I try to compare the poly market chances of reopening of the strait. Interest rates are taking its cues directly from those probabilities. Crude oil is taking its cues directly from those probabilities, and yet the S&P 500 is not. And at some point, it's going to matter. I think there's a threshold. I don't know if it's 5% in the 30-year, 460 in the 10-year, but at some point, it's going to matter, and that's going to put some downward pressure on valuations. The good news is earnings continue to trend higher. We started the year expecting about a 13.5% earnings growth for the S&P 500. That has now shifted up to 16%, and that's off a Q1 that's been pretty strong.
Yeah, I want to get more into the markets now as well. There's just so much to talk about because obviously the markets are awaiting some mega IPOs from SpaceX, OpenAI, Anthropic. How do you expect these to kind of reshape investment strategies within the tech sector?
Yeah, it's a great question because these are massive IPOs. They certainly reflect a lot of the investor enthusiasm out there for this, large cap tech leaders. And it also reflects the amount of liquidity that's still available in the market. So when we see these massive IPOs, they have to be reallocated from elsewhere in the portfolio. We expect the multiples in other tech sectors, in fact, broader, we would expect that those multiples to shrink as investors kind of swap into these new IPOs. And it appears that they're coming fast and furious.
And staying with tech, obviously we saw earlier Washington acquire a stake in Intel. It's now announcing it's going to take equity stakes in quantum computing companies like IBM. Do you see government involvement as a positive or a negative for these companies and like the tech sector as a whole?
For now, I think it's a positive. The fact is that it's giving investors some confidence that the government is behind these things. They want to see these companies succeed. Intel certainly, since that investment, has done remarkably well. Now with quantum benefiting from government input, government equity stake, I think that's a positive. The good news is that the government isn't taking a controlling interest or even an interest large enough to change policy. So as long as policymakers walk that fine line and realize that, yes, an equity infusion is a good sign, but we don't want to be too big of a stake in these companies.
Okay, I do want to get to some of your stock picks as well, starting with your tech pick, Qualcomm. What makes Qualcomm a kind of standout chip maker within this crowded field?
Yeah, I mean,
here?
here's a chip maker that was pretty much left for dead about 6 months to a year ago, and has really been caught some fire with this huge demand. It turns out that unprecedented demand from AI has been remarkable. It's created its own little economy down here. In fact, Q1 business spending contributed more to U.S. GDP growth than household consumption. That doesn't happen very often. And Qualcomm's a high-quality company, strong cash flow. It has a reasonable dividend, and we expect it to grow its dividend well in excess of inflation.
You also like food company Archer Daniels Midland. Tell us why.
Yeah, very well positioned. Obviously, food has been a key element here in this higher prices, and particularly as we're seeing now higher fertilizer costs and food products going higher. Again, high quality company, strong cash flow, 2.7% dividend yield. We expect its dividend to grow at around the rate of inflation.
And just lastly, I believe we have time, your last pick, General Dynamics. Tell us why you like this one.
Yeah, again, fundamentally well-positioned. Obviously, defense aerospace is strong, not only in the U.S., but we expect many of our European partners to ramp up their spending. But the underlying theme here, again, is a high-quality, strong cash flow, 1.9 dividend yield, and dividend growth well in excess of the inflation rate.
Okay, we'll leave it there. Jack Ablin, Chief Investment Officer and founding partner at Crescent Capital. Appreciate your time. Thank you.
Thank you.
Coming up, a multi-billion-dollar investment in quantum computing south of the border. We'll tell you what it means for the industry after this. Quantum computing stocks are getting a boost today after the U.S. government has agreed to award IBM $1 billion U.S. to build a foundry for quantum computing chips, along with smaller awards to other quantum computing companies, totaling a little over $2 billion U.S. The nascent technology is said to potentially deliver progress in fields like drug discovery, finance, and computing encryption. So to discuss more, we were joined by Antoine Legault, Vice President in Equity Research at Wedbush Securities.
Today is a momentous day for the industry. I think today's announcement signals not just optimism, but commitment. Right, capital is being allocated, $2 billion, as you mentioned. Supply chains are being planned, and the ecosystem is beginning to coalesce around the idea that utility-scale quantum is a matter of when, not if. So historically, pure-play quantum companies have made the technical case, but now we're seeing, the incumbents like IBM, Global Foundries, making this industrial case. Right, and that combination, frontier innovation meeting manufacturing scale, in our view, is how nascent technologies become transformative ones. So to answer your question, it's a big boost, but I would remind our viewers that most of the pure play quantum companies are very well capitalized already. So though it's not, a bit of extra cash doesn't hurt at the same time.
I wonder what the reason for it is then, right? Like the U.S. government is said to receive a stake in these investments. Is that part of the reason? Do you think that's worth the investment for the U.S. government?
Correct. I think the Department of Commerce now is institutionalizing, a new model of government participation, right, in a strategic technology development, and that it creates aligned incentives, tries to preserve taxpayer upside, and avoids the pure subsidy optics that have historically made policies politically vulnerable. But beyond the direct recipients and the $2 billion of funding being allocated across the industry, which is significant. We see the more important ramification as being the likely added positive attention this investment will bring to quantum companies, given the recent success the U.S. investments have had, like we've seen it with Intel, and the perception that U.S. policies going forward will be tailored to continue to support these investments. And then the last thing is just the national security halo effect it provides the entire space.
Got it. Okay, so I think just for our viewers that maybe don't know, maybe we can talk a little bit more about quantum computing, what it does, first of all, compared to other methods, and just maybe explain that before we get further into this conversation.
Yeah, absolutely. So at its core, the promise of quantum computing is that you could solve problems that are now intractable, or in other words, impossible to solve. Right. So it's not just about a speed up in compute time or marginal improvements. It's about a paradigm shift to one day being able to solve problems that otherwise are not possible to with today's supercomputers or even state-of-the-art high-performance computers. So what that means is solving protein folding or discovering new drugs, and same with batteries. Battery technology could use some help from quantum computers, solving very, very large problems that would take thousands of years for today's traditional computers to solve.
Then I wonder how it could potentially impact other technologies like AI, for example.
Yeah, absolutely. So in the future, the promise, or what pure play quantum companies have said, is that they plan on integrating AI data centers, right, which is now sort of a multi-$100 billion industry. We're seeing that across multiple companies that are deploying hundreds of billions of dollars a year in AI capex. So the long-term promise is that this industry will merge together with AI and improve large language models, improve efficiency, and there's just so much that we don't yet know in terms of what it can do, right? Because we're not yet at the point where we've reached quantum advantage, so to speak, or the fact that quantum computers could outperform classical computers. We're not quite there yet, so there's a lot that we still don't know, but it's a very promising field.
Out of the companies named to be receiving this investment, right, these funds coming from the incentives under the 2022 Chips and Sciences Act, which ones do you think, besides IBM, like there's a couple of others, Global Foundries, for example, D-Wave, which one do you find is building something of significance to kind of watch out for?
Well, it's difficult to pinpoint exactly which company, because they all have unique approaches and they all have promising technologies. So, of course, IBM has sort of established itself as a leader in the field, given the size and scale, and also they have the manufacturing and they have the history behind it. But Rigetti and D-Wave, I think notably, have very promising technologies and roadmaps. So I think those two would be some to watch for.
And just in terms of sectors, quantum computing referenced as effective for drug discovery, encryption, finance. Is there a certain industry or sector that could potentially strengthen the most once quantum computing really gets up and running?
Well, I think what has been said is the pharmaceutical industry could tend to benefit from quantum computers, given just the large amount of computation needed to do protein folding and drug discovery. I mean, that is an area that I think some of these companies are seeing a lot of interest from already.
That was Antoine Legault, Vice President in Equity Research at Wedbush Securities. Up next, Donald Trump has postponed signing an executive order intended to increase government oversight of advanced AI models. We will discuss the likely reasons behind the U.S. president's decision to back off when we return. Shares of Lightspeed Commerce took a hit today. That's after the point of sale and software provider posted profit for its latest quarter that missed estimates. Adjusted earnings also came in lower than what analysts were expecting. In addition, Lightspeed's revenue outlook for its current quarter, along with its fiscal 2027 goals, also missed the mark. Stellantis has unveiled a $70 billion turnaround plan. The major reset includes focusing roughly 70% of investments in key brands, including Ram, Jeep, and Fiat. Stellantis will sideline Chrysler, Romeo, and Opel. Now, the strategic outline also includes a new savings goal and aims to boost profit and raise returns in North America and Europe by 2030. Shares of IBM saw a surge today. The American company will receive $1 billion US as part of the Trump administration's investment in quantum computing. The government is pledging a total of $2 billion US, with a grant also going to global foundries developing specialized chips for quantum computing. The investment will give the US government a stake in those companies. Canada Pension Plan Investment Board notched a 7.8% return in its most recent fiscal year. And for the details, Bloomberg's Leanne Oda joins us now with more. Leanne, great to have you. So I guess tell us, first of all, what were some of the biggest drivers behind the performance that we saw?
So real asset investments contributed to the returns. They gained around 12%, and the returns in real assets were driven mostly by data center investments and by also energy investments, particularly sustainable energy investments in North America. Most importantly, the biggest driver for growth was the stocks, the public equities. They made around 17% returns, and they particularly contributed was from the U.S. stocks in IT and also in communication services.
With that in mind, then, is CPPIB planning to invest more in stocks?
Actually, I spoke this morning with John Graham, the CEO of CPPIB, and he said that he's becoming increasingly uncomfortable by the rich valuations of the stock market, and because since they are heavily concentrated in the Magnificent Seven, and he said that over the last 3 years, one of the biggest challenges that institutional investors globally are contending with is the soaring valuations in the stock market and the high level of concentration. And he said that in circumstances or in times like these, the pension tends to lean even more heavily on diversification, since they are not trying to chase the market, and they will invest in public equities, but they also will allocate capital to credit, to infrastructure, to private equity, as well as real estate.
And CPPIB also pointed to losses from the weaker U.S. dollar. How significant is currency exposure for global pension funds?
Yeah, so for the year ended March 31st, USD made up around 50% of the currency exposure mix for the pension plan. It's important to note that the Maple 8 are among the largest holders of U.S. assets, so any unfavorable movements between the loonie and the greenback can heavily impact the investment returns. And in this case, for CPPIB, the foreign currency incurred losses of around 12 billion Canadian dollars.
Interesting. Private equity returns relatively muted again this year. Is the asset class still struggling from the slowdown in deal making and exits?
So there were three factors that impacted the private equity performance this year for CPPIB. One, it's because the portfolio is not heavily invested or is restricted in its investments in the capital intensive companies that usually or that are benefiting from the AI boom. Second, they have exposure to software assets which have been impacted or negatively impacted by fears of AI disruption. And thirdly, the private equity portfolio is particularly invested in or heavily invested in the U.S., around 60% exposure, and it was impacted by the weakening of the U.S. dollar.
Okay, we will leave it there. Bloomberg's Leanne Oda joining us live. Appreciate your time. Thank you. Meanwhile, U.S. President Donald Trump has postponed signing an executive order that would have increased government oversight of the artificial intelligence industry. Donald Trump stating he did not want to slow the U.S. in the AI race against China. Let's get more now from Gregory Allen, CEO of Decision Tree Research and former U.S. government AI policy official. Great to have you join us.
Great to be with you.
So Donald Trump said that he didn't like certain aspects of this new executive order. Do you believe Trump is personally hesitant to approve it, or is more of this push really coming for AI oversight really coming from some of his political base?
Well, I think Donald Trump is personally interested in the AI issue and takes it very seriously, both in political terms and economic and national security terms. So he really does care about this. And given that the White House had invited technology executives to fly down for the photo shoot, I have no problem whatsoever believing that Donald Trump personally decided to slow roll this executive order as they try and figure out whether the government prior review period of frontier AI models should be a longer period, something like 90 days, or a much, much shorter period, maybe as little as 14 days, which some industry companies are advocating for.
Interesting, because Donald Trump stated he didn't want to do anything that's going to get in the way of the U.S.'s lead over China in AI. Would an executive order like this, though, help maintain the U.S. lead over China, or could it unintentionally accelerate China's progress instead?
Well, I think there's two ways to look about this. I mean, the first thing is all of this is downstream of what we've seen come out of Anthropic with its Mythos model. Anthropic basically went to the big banks, the big technology companies, the big cloud computing providers, and the United States government and said, you will be astonished at how capable this latest model is. Some of what I've heard from folks in the industry is that perhaps as many as half of all cybersecurity vulnerabilities discovered ever have been discovered by the Mythos model in the past 2 months. I mean, this is an astonishingly powerful model when it comes to a national security relevant capability like cybersecurity. So before you put that out into the wild, before you give access of that capability to the general public, it certainly makes sense for the government and for companies that are critical to global cybersecurity infrastructure to have a peek and understand just what exactly they're dealing with. But the criticism about the race against China is also reasonable. If you think about a 90-day government review period, a period between, when the company thinks the model is ready for public release and when it actually is ready for public release, that's 1/4 of a year. And at various times, most recently with the DeepSeek V4 release, a lot of folks think that the United States' leading companies are only 1 year ahead of China. So we're talking about consuming 25% of the United States' technological edge, at least in calendar terms, for this safety review. So you can understand why the government wants to make sure that this absolutely is necessary.
Right, because the president also saying AI analysts are convinced Beijing is currently winning the AI race. I know you don't think that. Do you believe that China is really just 1 year behind?
So it depends what is your yardstick or your measuring stick when you're thinking about what this race really constitutes. If you're talking about the absolute bleeding edge of capabilities, there does appear to be a pattern where what Chinese companies are able to release, oftentimes in open source, is somewhere between 6 and 18 months behind in terms of benchmarks that measure the performance of a model. But that's a big difference between absolute performance and consumer adoption. To give you an analogy, think about Apple, the maker of the iPhone. Apple makes only a tiny minority of the smartphones that are sold worldwide, but it makes a majority of the entire industry's profits. And the same is true of artificial intelligence. China may be gaining in its technological edge, but it's not gaining in terms of paying customers around the world. And companies like Anthropic have literally been growing tenfold every year since they were founded. And of course, if you've ever seen, NVIDIA's revenues, you'll understand that this is a titanic edge in terms of the actual business of artificial intelligence. So while China's capabilities are not irrelevant, and we should never take the U.S. lead for granted, they're enormously capable over there, the reality is the United States is massively ahead in the adoption that actually involves paying customers, which is, of course, what funds the revenue for research and development and continued technological progress.
And just lastly, I apologize, we'll have to be quicker with this last answer, but it's a broad question. Like, why is winning the AI race considered important? And is there ever going to be one winner when you look at the evolution, the constant evolution of AI?
Well, if you look back throughout history and strategic geopolitical competition, the United States' edge in computer technology was really foundational to how the Cold War played out, not just in economic terms because of all the money that we made from being good at computers, but also for military terms, in terms of the precision-guided munitions, which literally did scare the devil out of Soviet generals as they were thinking through what war scenarios might mean. And leaders in both the United States and China think that leadership in AI technology is foundational to the future of military and economic power.
Okay, we're going to have to leave it there. Gregory Allen, CEO of Decision Tree Research and former U.S. government AI policy official. Really appreciate your time. Thank you.
Thank you.
Shares of Lightspeed Commerce are under pressure after the Montreal-based point-of-sale company posted its fourth quarter results. We will bring you a conversation with the CEO when we come back. Lightspeed posted its Q4 results this morning, resulting in the stock dropping. And we dove into it with Dax Da Silva, CEO and founder of Lightspeed Commerce.
We're looking at typically at adjusted free cash flow. For the year, we generated $18 million and 73 million in adjusted EBITDA. So we have some depreciation of formerly acquired assets that contributed to the net loss, and that should conclude at the end of this quarter. And so, looking at the year, we just finished our first fiscal year. We're really excited about the results after that full year of transformation. We have a 3-year transformation plan. So, ending the year at $1.2 billion of revenue, crossing that threshold, as well as generating free cash flow, as well as location growth grew 11%. That's a high water mark from 5% in the first quarter of the fiscal year.
So 15% year over year with what you were just saying. How do you see that continuing? What's going to drive it?
Yeah, so we've been doubling down on our 2 growth engines as a part of our transformation. That's retail in North America and European hospitality. We grew in those 2 growth engines, which now, post-divestment, we divested an asset called Upserve, which was U.S. hospitality, a non-core asset. And now those growth engines in FY26 make up 75% of our business. They'll trend to 80%. And in those growth engines, we grew 24%. So really top tier growth, and the location growth is coming from those markets. That's also an 11% growth in GTV. That's all the transaction volume. So that I think sets up the company for to really win those markets where we have the right to win, where we have a great product market fit. We serve complex retail verticals in North America, and we're the leader in full service restaurants across Europe.
And what kind of competition are you facing in those 2 sectors? What gives you that confidence that you can grow those numbers?
European hospitality is very fragmented. It's country by country. We're the only pan-European solution. So if you're opening a restaurant chain or switching from a legacy system, Lightspeed is the solution. So we just closed a very popular chain in Europe called Gaucho. It's an Argentinian steakhouse, across the continent, but primarily in the UK. In North America retail, we're very strong in our key verticals: sport and outdoor, which includes bike and golf. and running, ski shops, very, very strong multi-brand apparel, jewelry, home and garden, because we integrate with the brands, we integrate with the suppliers in those key verticals. So we go beyond point of sale, we go into integrating with their key vendors and giving them workflows that nobody else can offer. And now with AI, building agents that take a lot of the challenges of those complex, tedious, laborious workflows that are extremely time-consuming and human-intensive, and offering agents that can give those folks that are doing that critical buying piece, options for assortment, negotiation. All of these elements are being built out, and we've got a rapid development velocity and pace of delivery. So we're excited about how that's trending for the company.
Okay, excuse me. On software, your subscription revenue grew only 6.2%, below your medium to long-term targets, and your SaaS ARPU decelerated as well. What's happening there?
So we are lapping price increases from earlier in the year. Growth engines for the year grew 15%. So in our non-core markets, we're cross-selling and upsell less than we are in our growth engines, where we've got much richer product suites. So we're seeing a lot of vitality on the growth engines, which, as I said, in FY27 will make up 80% of our revenue.
All right, and just bigger picture, everything you do is, a lot of it's connected, obviously, to consumer spending. Any concerns about that slowing down?
So we've had a very constructive macro environment for Lightspeed and its merchants and the consumers that buy generally high value inventory this whole fiscal year. So that's been a positive. And we see same store sales in our key verticals, like I referred earlier to golf and bike, home and garden. Some of those supplies were heavily purchased during the pandemic, and so we've seen muted sales in the interim years. But now we're seeing a lot of new purchases in those verticals, and we're very heavily penetrated in those verticals. So that's been constructive for the company as well. And of course, in European hospitality, they've had very, very strong seasons. I think tourism in Europe is widely regarded as very strong.
That was Dax De Silva, CEO and founder of Lightspeed Commerce. Up next, we look at property and casualty insurance and how the market is performing in Canada. Stay with us. Property and casualty insurance covers both protection of personal assets and protection from liability against third-party claims. And we got more on that from Rowan Saunders, CEO of Waterloo-based Definity.
As you know, Definity has been a building company, and we've just completed a large acquisition in the first quarter, which is early days, but going very well. And I would say the overall environment for the business is pretty attractive and pretty conducive to our long-term plans, which is to grow faster than the market and build a top 3 Canadian P&C insurer.
Let's talk about that acquisition of Travelers Canada. How has it contributed to the firm's recent performance so far?
Well, actually, our first quarter was a really important quarter for us, because this is the first quarter that we published the earnings of the combined business. So on January the 2nd of this year, we closed the pre-announced Travelers transaction. So this is a very substantial acquisition, a $3.3 billion acquisition for Definity that moves us into the top 5 insurance companies. So very strategic. Closing went a little earlier, a little better than we thought. So that was all very good. And we've been very busy in the first quarter, now onboarding about 1,500 employees, about $1.5 billion of revenue, and starting to work on the integration plans for the business. So a really positive start to the integration process. And then I think the other thing that we were very pleased about was the core business delivered very strong performance. So our growth in the first quarter was 35%, heavily influenced by the addition of the Travelers portfolio. We had a combined ratio of 92.9%, and actually we had a record earnings in the first quarter of an underwriting profit of $100 million, and that's the first time we've done that in the first quarter. And then in Canada, the first quarters for a P&C company can be a little tricky because we had a real winter, as well. So off to a very good start.
You say now you're in the top 5. I mean, as I hear you're onboarding more people because of this acquisition, but being in the top 5 now, like, has that changed how you're going to operate? Has that changed any of your models moving forward?
Well, I think one of the things it does is it actually adds a lot more capability and breadth of product offerings to the marketplace. So when I think about, Definity's journey, which we've been organically growing at about twice the rate of the industry, we've been increasing the share of our commercial business. So that's been the faster growing part of our business as we moved out of being just a small mid-market player into large and specialty. What was very strategic about the Travelers acquisition is that, we'll get somewhere around 35 to 40% additional growth in our commercial lines business. But what importantly it does is it opens up the total addressable market for our commercial capabilities by about $7 billion of opportunity. And so that's going to help us, continue the growth for some time to come. And it's given us, more relevance with our big broker partners and actually more products that we can then cross-sell into the existing Definity business. There are many lines of business that, for example, directors and officers, ocean marine, technology, that Definity didn't offer to the marketplace, but now we've acquired Travelers. We have those products. We have the seasoned underwriting and claims capabilities to do it. It'll be a new product offering for us.
Are you eyeing any other acquisitions at the moment?
Well, I think part of our story is that we're confident we've built a great platform that can help us continue to grow by both organic growth and acquisitions. And so we're always looking to deploy capital. I think one of the points that we're delighted about is we've just done this, I'd say, transformational acquisition. We spent $3.3 billion, as I mentioned. And here we are just one quarter in, and our financial capacity to do further acquisitions is already over $1 billion of capacity. And that's because the company is quite cash generative, the earnings are very strong, and we acquired a very strong balance sheet from the Travelers organization. So financially, we have the capacity to deploy more capital. And the real focus in the short term is about making sure that it's a smooth integration process. We retain the talent, we retain the customers, we make it a smooth process as we literally move on about 500,000 customers from the Travelers platforms onto the Definity platforms. But yes, we are still looking to deploy capital and continue to participate in what we think is an industry that is going to continue consolidating.
Interesting. Okay, so we'll keep an eye on that. I just wanted to ask you before we wrap things up here. Of course, in the last couple of days, we've seen a sharp bond sell-off, global yields rising on the Iran war for the most part. With that in mind, how are insurers considering investments in Canadian bonds at this time?
Yeah, it's a big part of our portfolio. So when you think about our investment portfolio, we have about $9 billion in our investment portfolio, heavily weighted to fixed income. I think that what we focus on is making sure that we have good duration matching between our liabilities and our assets. So that influences. We generally have about a 4-year duration plan. We have, however, traded up into higher yields in the last couple, of months. And actually, that's one of the positives that we've been able to up our guidance on net investment income for 2026. So we were targeting about $300 million of net investment income. We've now moved that up to over $320 million. So we've actually taken advantage of some of the yield increases available in the marketplace. It's a very safe, prudent investment portfolio. So we're watching, of course, what's happening around the global markets carefully.
That was Rowan Saunders, CEO of Waterloo-based Definity. Well, $1 billion bill is heading Canada's way for the World Cup. CTV's Andrew Johnson has more on how that stacks up against other host countries.
With the transformation of Vancouver and Toronto into World Cup cities just about complete, excitement is building.
I think it's great to see the festival here and all the games and everything coming into town. Money well spent.
A cost that's now eclipsed $1 billion, according to Canada's budgetary watchdog, to host 13 games in June and July. That's roughly $82 million per game, which is actually less than Russia spent to host in 2018, Brazil in 2014, and South Africa in 2010. But one sports economist points out co-hosting alongside the U.S. and Mexico, what we're paying for doesn't quite compare.
We're not getting any of the major elimination matches. We thought that if we were hosting the World Cup, we would actually see something of consequence.
Close to $500 million for FIFA is coming from Ottawa, the rest provincial and local, to pay for security, infrastructure, and stadium upgrades. The host cities are counting on a big benefit. BC's premier says the tournament will bring 1 million visitors to Vancouver over the next 5 years. The mayor has led the charge.
This is an amazing opportunity. It's going to be a month-long commercial.
Critics claim otherwise.
I've been saying for 8 years now, give or take, that we were sold a false bill of goods, not by FIFA, but by our politicians.
How do Canadians feel? Well, the latest polling from Leger showed close to 3/4 of Canadians support hosting World Cup matches, but a majority indicated their biggest concern is taxpayer costs. And the final number isn't in yet. Andrew Johnson, CTV News, Vancouver.
Okay, that's it for us. Thanks for joining us today on The Close. We will see you tomorrow.